or hours. Because of this, technical analysis can be useful for both long-term investors and short-term traders. Another advantage is that it helps identify more precise entry and exit points. Even if an investor relies on fundamental analysis to decide what to buy, technical analysis can provide guidance on when to buy or sell. So fundamental analysis can help pick undervalued cheap stocks. The technical analysis can help to decide when to buy those undervalued stocks. So they indicate the good optimal entry and exit point to buy those undervalued stock determined by the fundamental analysis. And finally, I think technical analysis relies on visual patterns, which can sometimes make market behavior more easier to interpret. So chart and trends allow investors to quickly gather price movements and potential signals. However, this does not mean that technical analysis is always accurate and correct, which lead us to the next topic. Despite its popularity of technical analysis, it faces several criticisms. So one major challenge comes from the efficient market hypothesis, the EMH. According to the efficient market hypothesis, the financial markets are highly efficient, meaning that the prices already reflect all available information. Even in weak form efficient market hypothesis, they hypothesize investors cannot earn excess profit by using those past information, which is the past price movements or trading volume. And if markets are truly efficient, so the past price movements should not provide useful information about future price changes. So simply speaking, a chart pattern should not consistently generate excess profit. Another criticism is that some technical patterns may appear meaningful only after the fact. Investors may look at historical charts and identify patterns, but these patterns might not have been obvious in real time. In addition, the appearance of chart patterns can depend on the time horizon of the chart. For instance, a pattern that appears clear in a daily price chart may look quite different when we examine a weekly or monthly chart. There is also a smoothing effect when data are aggregated. When we convert daily prices into, say, monthly price or monthly returns, much of the short-term fluctuation disappears. As a result, a chart pattern that seems visible in daily data may not appear in monthly data chart, even when the overall time horizon is the same. Because of those issues, the interpretation of technical patterns can sometimes be subjective and sensitive to the choice of data frequency. For this reason, many investors combine technical analysis with other approaches, such as fundamental analysis. rather than relying heavily only on technical signals alone. Now that we understand the basic assumptions behind technical analysis, the next question is, how do technical analysts actually study price movements? The most important tool they use is the chart. The charts allow investors to visualize how prices move over time. Instead of looking at a long list of numbers, the charts make it easier to identify patterns, trends, and sometimes a turning point in the market. There are several different types of chart used in technical analysis, and the most common chart include the line chart and the bar chart and the candlestick charts. Or there are sometimes called a point and figure charts. Each chart presents price information in a slightly different way. Some charts are very simple and focus only on the general trend, while others provide more detailed information in the chart about price movement within each trading period. So in the next few slides, we will briefly look at the most common chart types, say bar charts or candlestick charts, and understand what kind of information each chart provides. The line chart is the simplest type of chart used in technical analysis, like this. A line chart is constructed by plotting a single price point for each time period. So it shows the price only. Usually, the closing price, and then connecting these points with a line. So these lines are drawn from the closing prices. Because it uses only one price per period, the line chart provides a very clear and simple view of the overall trend. For instance, if we look at a line chart of a stock over the past year, say this is a year, annual chart, we can easily see whether the stock has been generally rising or moving or sideways or declining. However, the line chart does not show other important information such as daily highs or lows or opening price. So for this reason, many technical analysts prefer more detailed chart types, say candlestick chart. And a bar chart provides more detailed information than a line chart. Each bar represent one time period, typically 1 day. The vertical line shows the range between the highest and lowest prices during that period in a day. In addition, the bar includes small horizontal marks that indicate the opening price and the closing price. Because bar charts display 4 pieces of information: open, high, closing, low. They are sometimes called a OH, open, high, low, close charts. This additional information allows investors to better understand daily price volatility, daily price variance, fluctuations, or volatility, and market behavior. For instance, if the closing price is much higher, say closing price is much higher than the opening price,